Welcome to our channel on accounting lessons with worked out problems. Brought to you by an experienced accounting professor with a CPA. This first video introduces accounting basics for those who need to refresh the basic concepts before we start our step-by-step illustrations of accounting problems. We have videos on all topics of financial accounting. Please do not forget to subscribe. Let us go to the video. This short video refreshes the basic concepts of accounting, beginning with the definitions and examples of accounting terms such as assets, liabilities, and owner's equity. It briefly reviews accounting types such as permanent accounts and temporary accounts. The last part reviews the accounting equation that describes the financial position of a firm.
Now, terms and definitions. Assets. What are assets? These are properties that have a value and is owned by the firm and it should be used in the business. Now, all these characteristics should be present. If one of the elements is lacking, then that particular property cannot be classified as an asset. Examples: cash, receivables, supplies, inventory, land, building, and machinery. If these are used in the business, then they will go under the account group called assets. Now, the liabilities. What are liabilities? These are money or any other things of value owed by the company to other parties, such as banks, creditors, supplies, vendors, employees, etc. And some of the examples of liabilities are account payable, wages payable, unearned revenue, taxes payable, interest payable, loan or notes payable. Then comes the owner's equity. This can also be listed as the shareholder's equity. Now, what is the owner's equity? Now, this account group gives you a report on the total money invested by the owners in the company. Now, this account has two sub-accounts. First is the capital stock or stock. This is the amount directly invested by the owners or the shareholders. That is, when the owners give the cash to the corporation or the company and get the stock in exchange. Second one is retained earnings. This is the profit earned by the company and retained by the company. For example, if the company makes a profit of $100 and out of the $100, $20 are paid out as dividends to the shareholders or the owners. The remaining $80 are retained by the company. Now that $80 will be accounted in the retained earnings account. Now come the dividends. Dividends are otherwise called withdrawals. These are the money paid to the owners or the shareholders from the profit earned by the company. Now, every time dividends are paid, the retained earnings account balance will decrease. Now, we have types of accounts. So these account groups, that's assets, liabilities, and owner's equity, okay? And also, we are going to see more accounts later, and they can be classified in types or groups. Permanent accounts. Now, these permanent accounts show the financial position of the firm. Now, what are the permanent accounts? Assets, liabilities, and owner's equity. So, these permanent accounts will have their balances rolled over to the next accounting period. Now, temporary accounts. What are the temporary accounts? These are the accounts that have an economic impact on the financial position of the firm. Revenues, expenses, and dividends. Now, what are revenues? Revenues are cash or other assets earned by the company by either selling goods or providing services. For example, when Walmart sells goods to the customers, whatever the customer pay is a sales revenue. Now, if you go into a tax company and they are doing your tax return and you pay them money, now that will be provided, that is the company earning by providing services, that can be called service revenue. Some of the examples are sales revenue, service revenue, interest revenue, rent revenue. Expenses. These are the cash or any other asset paid or a liability incurred for using the goods and services of other people. Examples, rent expense. When a company is using an office building or a space that belongs to other party, then the company has to pay the rent, and that will be the rent expense. Wages and salary expense, these are the cash paid to the employees because the employees are giving their services to the company. And other examples are interest expense, insurance expense, tax expense. Now, finally coming to the accounting equation. This is the very important part of accounting. Now, accounting equation is assets should equal liabilities and owner's equity. Now, in this equation, we don't see the accounts, revenues, and expenses. Why? Because revenues and expenses, they are temporary accounts, and any economic impact of revenues and expenses will be added to the owner's equity. So, under owner's equity, the two accounts that impact owner's equity are revenues, expenses, and dividends. Since those accounts influence on the owner's equity is added to the owner's equity, we do not include those accounts in the accounting equation. Now, this accounting equation, assets equal liabilities and owner's equity, should always be in balance. That is, if anything increases or decreases on one side of the equation, there should be a corresponding increase or decrease on the other side of the equation or on the same side of the equation. Example, let us say the owner is investing cash in the company, $1,000 cash. So cash is an asset. So asset, which is on the left side of the equation, increases. Now that 1,000 is an investment from the investors or the owners. So on the right side of the equation, owner's equity increase. That is one example. Another example, let us say the company is repaying its loan. So what happens is it's going to repay its loan by paying cash. So liability on the right side of the equation will decrease. There will be a corresponding decrease on the left side of the equation. That is, the cash is paid out, so assets decrease. Now sometimes there may not be an increase or decrease on the other side, but it can happen on the same side of the equation. Let us see an example on that. Let us say the company buys inventory, which is an asset, by paying cash. So here, both the inventory and cash belong to the assets. So one asset, inventory, is increasing, and the other asset, cash, is decreasing. So the equation again stays in balance, but there is no change on the other side of the equation.
In this video, we reviewed the accounting basics with the definitions and examples of accounting terms, accounting types, and the accounting equation. In the next video, we will illustrate the concepts of journal entries, ledger accounts, and trial balance with a worked-out problem. We hope to have you there. We have videos on all topics of financial accounting. Please do not forget to subscribe. Thank you for watching.